Word on Wall Street, top investors watching your money. Joining me now, Michael Lee Strategy founder Michael Lee and Walser Wealth Management President Rebecca Walser. Rebecca, I end with you. I begin with you. I stole that from Neil Cavuto. He always says that. U.S. move on to my next topic, Mike. How does your view line up with Rebecca's on that?
Almost exactly. From a technical standpoint, if you're just looking at price action, the market is looking very constructive. But on a macroeconomic standpoint, it's looking like a train wreck. So for me, it's how can I have my cake and eat it too? And it's being positioned in defensive sectors and adding positions like gold and the 30-year treasury so that if we do get a weaker dollar, rising stock prices, rising equity markets, that my clients can still profit, where if the bottom falls out, they're protected to the downside.
So, Mike, I want to move on to home builder sentiment from the National Association of Home Builders is out on Wednesday. The expectation is that we'll hold steady, but it's still at the lowest since June of 2012. We also get building permits, housing starts, existing home sales later this week. Your take on the housing market, and particularly as an asset class, it's not liquid, but nevertheless, you certainly need to treat it that way.
So, Dagan, it's funny you say hold steady. It's going to hold steady because I don't know that it can drop any further. I mean, we went from the mid-80s to 31 on the National Home Builders Sentiment Index. This is a horrific collapse, and that horrific collapse has meant a recession 10 times out of 10. It typically signifies a double of the unemployment rate and earnings that contract somewhere between 10 and 15% for the calendar year following that happening. Right now, estimates are for over a 5% increase for this year. So at some point, those two need to reconcile, because when you look at building permits, housing starts, new home sales, and home builder sentiment, every single chart there, it's not like stock charts that are looking constructive. They start in the top left and they end in the bottom right. They all look identical. It is horrific data. And, if you think about it, this makes sense. In the fact that during COVID, with interest rates at all-time lows, particularly mortgage rates, and the way people wanted to live, moving from kind of this live-work play in a city, in a suburb, living on top of each other, to just more and more space, wanting a bigger home with more land. That was a fundamental shift in the overall economy. And now with a 30-year mortgage goes from 2.8, 2.9 to 7.5 in certain circumstances, that's certainly going to slow that down, combined with the slowing economy and runaway inflation. Impossible to get materials to build homes, skyrocketing the price. So a lot of factors working against it. And we look at ourselves now, we are, in my mind, entering a recession. So this should slow down. This should bring home price affordability down, which would be good for first-time home buyers. But what I would say is people that have doubled their home prices over the last couple of years, you're going to give, if you haven't already, you're going to give a lot of those gains back. And I don't know that we're going back to 2019 valuations for a lot of homes, but I do think a lot of the gains saw in the pandemic are going to be given back over the next couple of years. I don't know that that's the worst thing. And it'll be interesting to see where mortgages end up this year if the long end of the curve trades down significantly. Some smart bond people saying we're going to see a 2% 10-year by the end of this year. And mortgage rates, for those watching, are not based on the Fed funds rate. It has a lot more to do with where the 10-year treasury is if you're looking at a 30-year fix. So if mortgage rates come down because interest rates come down dramatically, and the only way interest rates are going to come down dramatically in the long end is from a dramatic economic slowing, which is what I believe is going to happen, that could level out the housing market, so we don't have this sort of volatility, because you don't want to see a home that was $500,000 in 2019 selling for $1.1 million a year ago back to $400,000 by the end of this year. You want to see a steady 2 to 3%, maybe 5% growth year over year, but not this up 20, up 50, up 80, and then giving half of that back. I mean, that makes it really hard to build new homes, and the housing sector, it's so significant in terms of the multiplier effect and people, putting in new bathrooms, buying new furniture, all sorts of different things of people working on it. So it's a huge leading indicator for the economy because of its multiplier effect.
Right. And broadly speaking, there's very little inventory on the market right now. So it's very hard to gauge anything because people are not putting their properties on the market for fear. Well, because again, they're still delusional about what it's worth. Mike Lee, which happens when you flood the world with money, these central banks. Mike Lee, Rebecca Walser, great to see both of you. Coming up, the China threat looming.